All right, and the reason why we're recording this is to make it on demand so that everyone who wasn't able to attend today can watch it later, and also people can find it online, hopefully. So with that out of the way, welcome, thank you. If you've made it this far, we're now on our fourth and final Social Security webinar. This one's going to cover special circumstances. So we talked a little bit about in the third Social Security webinar, we talked a little bit about situations involving divorce and widows and widowers, just in the context of the special considerations that women need to be aware of when filing for Social Security. Today, we're going to take a little bit of a closer look. There's going to be some redundancy around divorce and widows and widowers, as well as the still working part. We've covered this a little bit in previous webinars, but we're going to be approaching things a little bit differently this time. So hopefully there'll be some good new information in there for everyone on our webinar today. So once again, my name is John Howard. I'm a CFP, a certified financial planner with SeaCure Advisors. Helping me with the Q&A today, as happened in the previous three webinars, is Carolyn Howard, who is my mom, and also our CEO and the founder of SeaCure Advisors. Can you say hello?
Hello and welcome. We hope you have a lot of good questions. Let's give him a challenge.
Okay, all right, very good. So let's see, a little bit of housekeeping. There's going to be, as we go through the slides today, as there have been in the previous webinars, there's going to be a link at the bottom of your screen, and that link will, if you know, you won't be able to click it, but you will be able to copy it down or do a screen grab. That will be the link you can use to schedule an introductory phone call with us. It's just a 15 or 20-minute call to get to know each other. And during that call, if there's additional help that we can offer you, we can schedule a meeting with you during that call. And our first meetings are always complimentary. And there are a couple folks who are on the webinar today who are existing clients. And obviously that link is not going to be relevant to you since we're already working together. But of course, our doors are always open. And if there's ever anything that we can do for you in regards to helping you understand potential Social Security claiming strategies, because I see the folks who are on, who are our existing clients, they're not yet claiming Social Security. So if this is something you want to discuss in more detail, we are happy to do that with you. Let's see. So also, the way our process works is that when the webinar is over, you're going to automatically receive an email with a link to a report card. It's just a Google form where you can go online and let us know what was working and maybe what wasn't working, as well as providing some information about yourself so we understand who's attending these things. All of this is designed to just basically ensure that what we're doing is of the greatest value to you as possible. So we're always looking to improve. If there's anything that we can do better, please let us know so that we can implement that the next time around. And with that, I think that covers about all of our bases. We can get going. So I'm going to share my screen. Here we go. And right out of the gate, we've got the Social Security website, which we're going to be talking about shortly. But we need to start the show. Here we go. So Social Security Education Series, part 4 of 4, special circumstances. Here are our disclosures. These are amazing. Hope you're a speed reader because we are moving on. Anyway, basic rule number 1 is that the monthly benefits that you claim from Social Security rise with your claiming age up until age 70. And this is really at the heart of everything that we do as planners around Social Security. Finding that sweet spot where you are receiving the income that you need in retirement and also getting as much as you can out of Social Security. There is a question that we have received offline from our previous webinars, where there's a concern that by claiming later and by taking more money from Social Security, you're basically hastening its demise. Of course, there's a lot of concern about the solvency of Social Security. If you're like me and you've looked at your Social Security statement, I have mine right here. Very handy. You can get this from the Social Security website. there is a disclaimer that right here on the first full page where it says your estimated benefits, there's a disclaimer that says your estimated benefits are based on current law. Congress has made changes to the law in the past and can do so at any time. The law governing benefit amounts may change because by 2035, the payroll taxes, that's FICA, collected will be enough to pay only about 79% of scheduled benefits. So this is right there on your statement. So of course, this is, it's in bold writing. This should rightly elicit some concern from the American public as far as what's going to happen with Social Security. Well, this happened before in the 1980s, and we're going to be covering it a little bit today. Some of the changes that were implemented back in the 80s, in 1983 specifically, that helped preserve the solvency of Social Security when there was a crisis back then. The woman who led a recent continuing education workshop that we attended as part of our certified financial planning requirements, we have to do continuing education. And we did a 3-day intensive, or actually it was a 4-day intensive on Social Security and Medicare. She's in her 70s and was told when she started planning 30 years ago or more that, that Social Security wouldn't be there for her in her retirement, and that she should assume in her own planning that it wouldn't be there. And so here we are, it still exists. And I firmly believe, I'm fairly bullish on Social Security. I believe it will continue and be solvent for the remainder of the century. However, I believe the framework, the underlying laws in terms of your maximum claiming age, the cost of living adjustments, how it's taxed, how the payroll tax system works. I think all these things are going to change, but I don't think Social Security is going to go away. And also to the point, to answer the question of does claiming earlier versus claiming later have an impact on the Social Security trust? Will this impact the solvency of Social Security? Will I be doing the rest of the country and the government a favor by claiming earlier and taking less money, or will it be hurting the government by claiming later and taking more money? The answer is it doesn't matter. The Social Security trust is a very complex system, and they have actuaries, the Social Security Administration does, that have constructed this system in such a way that they know that certain people are simply going to die earlier than others. And that based on all of the figures, and as actuaries, they are dealing with a lot of data, there is no net impact, plus or minus, on the Social Security trust in terms of when you claim. We're not going to get under the hood as to exactly how that works, but just know that there's no impact to the system as far as when you claim. So we're going to cover some definitions. This is going to be old hat for folks who are joining us for the 4th time, but the main terms you need to understand for the webinar today: number 1, primary insurance amount. This is the amount of benefits that you will receive at your full retirement age. And that is printed right up here in the top right corner of your Social Security statement. And what your full retirement age is going to be different depending on the year you were born. We're going to look at that in a second. But going back to the primary insurance amount, the PIA, this is calculated based on your 35 highest years of earnings. So what that's going to do, your oldest earnings are going to be indexed at a higher rate than your more recent earnings. So they all kind of level out. Your 35 highest years of earnings get divided by 35 and then divided by 12. And that's going to produce something called the average index monthly earnings number. And then bend points. You can see this term bend points up here on the screen. What those are is just basically kind of like the tax code, where at a certain level of income, you get a certain level of tax. At a certain level of AMI, or average index monthly earnings, you're going to receive a certain amount of Social Security benefit. And these bend points are such that the lower levels of the Social Security, of your AMI, the lower levels of that average indexed monthly earnings, those are going to count more toward your benefits, 90% up to about the first $1,000. And then there's 2 more bend points that allocate less of your AMI towards your actual benefit that you'll receive. And all of this is designed to ensure that Social Security has the greatest benefit for people at the lower level of the income spectrum, who are going to be much more dependent on this social safety net. The full retirement age, that is going to be age 66. I'm sorry, it's going to be age 65 for people born 1954 all the way down to 1943. And then they're going to add 2 months to that all the way up until the birth year of 1960. And at which point you are going to, I'm sorry, it might be 1967. I'm blanking. Sometimes it's all like, it's like you're typing too fast on an old typewriter and all the keys get jammed up. All you need to know is, yes, I believe it is 1960. If you're born after 1960, then your full retirement age is 67. Just know that your birth year, all you need to understand is that your birth year is going to be the deciding factor of what your full retirement age is. Sometimes, depending if you're doing your own research, if you're a DIY person like me, then you're going to be reading articles about Social Security. Full retirement age is sometimes called normal retirement age. So don't be confused about that. They're the same thing. The last thing I want to cover is that cost of living adjustments, COLAs. These are crucially important. The Social Security Administration likes to assume 2% on cost of living adjustments, but it does vary every single year. So this past year it was 1.3%, and our planning, which is very low. In our planning, we actually like to look at either 1 or 1.5%, depending on our clients' bullish or bearishness concerning the Social Security system. So key points to remember here: if you apply early, your benefit starts lower and stays lower for life. That's going to be magnified by COLAs, those cost of living adjustments. Because if you claim earlier, that annual increase, that adjustment is going to be applied to a lower number. If you claim later, it's going to be applied to a larger number, and these are going to compound over time. And of course, you need to think, if you're in a couple, you need to think about survivor benefits. And then also the factors that go into this are health status, life expectancy, income needs, and overall retirement planning, which can include pretty much as many factors as there are people. Everyone's retirement plan is unique, like a fingerprint, and all these things should not be, there is no one size fits all solution. They should all be considered uniquely with each case. And the life expectancy question is a very interesting one. I'm gonna stop the slideshow really quickly just to show you a tool here on the Social Security website. If you come here and go to the retirement estimator, you'll find that you can actually estimate your life expectancy. This is using the actuarial data collected by the Social Security Administration. So for me, I can select my gender and my date of birth. This is going to make it fantastically easy for cyber criminals to defraud me. Anyway, using this information, it will spit out some estimates. So right now, I'm projected to live to about 82. And if I make it to 70, I'll be projected to make it out to 86.7 years, and so on and so forth. So you can use this yourself. I like to take these numbers and add a little stress to our plans and maybe add 5 or 10 years to them. Because as you can see, these don't take into account a wide variety of factors like lifestyle, family history, and so forth. So very interesting stuff as far as how to use the Social Security website and helping with your planning. So we just showed you the Social Security website. You can use that to get your Social Security statement. You can create an account on there, and I like to check mine every single year. You can estimate your retirement benefits. Just going to quickly show you what that link is. So just going to back out of here, and just there's that retirement estimator, and scrolling down here. Hi, Susie Orman. You also have a whole bunch of items of interest, including publications, a variety of calculators that you can use. So some really great tools here on the Social Security website to avail yourself of. Moving right along. Basic rule number 2, a divorced person may be able to receive spousal benefits based on an ex-spouse's work record. No, it will not impact your ex-spouse's Social Security benefit. It is completely separate. But not every divorced spouse is eligible for divorced spouse benefits. There are some rules around these. We covered these in our Social Security Planning for Women webinar in some detail, but just to rehash these, your spousal benefit is going to be 50% of your spouse benefit, of the higher earning spouse benefit, if your marriage lasted 10 or more years, if the person receiving the divorced spouse benefit is currently unmarried, very important, and that the ex-spouse is at least age 62. They are able to claim their own benefit, is what that means. If the divorce was more than 2 years ago, the ex-spouse does not need to have filed for benefits. So in that case, it doesn't matter the age of the ex-spouse. It just needs to matter how long ago the divorce was. So there are a number of factors that go into this. It's actually been fairly surprising. We've had some meetings over the past year with folks who are in retirement and are actively getting divorced. And so this is something that is really worth paying attention to, especially if you're considering getting remarried. So notes about divorced spouse benefits. More than one ex-spouse can receive benefits on the same worker's record. It was actually pretty funny. The workshop we attended used the example of Larry King, who had a lot of ex-spouses, and they can all, a number of them would have been eligible to claim benefits on his worker's record. The benefits paid to one ex-spouse do not affect those paid to the worker, the current spouse, or other ex-spouses. These are all independent things. So don't think just because you're claiming a benefit that this is going to have a ripple effect that impacts other people beside yourself. To apply, show a divorce decree. So you would have to show proof of your divorce to the Social Security office, and the divorced spouse benefits will stop upon remarriage of the spouse collecting the divorced spouse benefits, not upon the remarriage of the primary worker's spouse. So all of this is to say that the main thing to understand is that what the divorced spouse, what your ex-spouse does, is not going to impact your ability to claim a divorced spouse benefit. They really are independent. Basic rule number 3, widows and widowers may receive survivor benefits. Could this apply to you in the future? Most likely. Unfortunately, it's something we all have to deal with. So we're going to talk about now who can get a survivor benefit. Eligibility for survivor benefits. The couple must have been married for at least 9 months at the date of death, except in the case of an accident. In the case of an accident like a car wreck, survivor benefits are available immediately. Heart attack, stroke, natural causes, those will require at least 9 months of marriage. The survivor must be at least 60 for a reduced benefit, or 50 if disabled. Now, this is an important factor, and it also applies to the divorced spouse benefit. You will get no extra benefit by delaying claiming a survivor benefit or a divorced spouse benefit by waiting till after your full retirement age. If that's age 67, as it is for me, I will get my full survivor benefit at age 67. I would, if my spouse were the higher earner. Same thing with divorced spouse benefits. You will get your full 50% divorced spouse benefit at your full retirement age. And by waiting, you will not get any increase. There's no delayed credits for survivor or divorced spouse benefits. The survivor benefit is not available unless the widow or widower remarries. If the widow or widower remarries before age 60. So again, sort of like the divorced spouse benefit, with this crucial difference that there's a cutoff. So with the divorced spouse benefit, that benefit will end as soon as you get remarried. With the survivor benefit, you will always have access to this as long as you are not remarried before the age of 60. If you're a disabled survivor, and we're looking at the Social Security definition of disability, which is pretty harsh. But if you do qualify, then you will be able to claim Social Security survivor benefits at age 50. And let's see, moving right along, divorced spouse survivor benefits are available, again, if the marriage lasted for at least 10 years. So all these qualifications have to be met in order for you to claim your survivor benefit. So let's take a look at an example here. Both are receiving benefits and one spouse dies. The widow or widower may switch to the higher benefit. So the example here, Julie and Joe are married. Both are over full retirement age. So that, in this case, let's assume it's 67. They're both older than 67. Julie's benefit is $2,000. Joe's benefit is $1,200. So that's more than half of Julie's benefit. So he's not getting a spousal benefit here, he's getting his own. But then Julie dies. So Joe notifies Social Security and his $1,200 benefit is replaced by a $2,000 survivor benefit. Now let's assume, let's change this up a little bit and assume that Julie actually had claimed her benefit early, before her full retirement age. If she had maximized her benefit by claiming at age 70, that's the maximum number of delayed credits as it attained at age 70, then this would have maximized Joe's survivor benefit. Joe does not have to wait till age 70 himself to claim Julie's age 70 retirement benefit if Julie is older than him. So there's a lot of spouses where there's an older spouse and a younger spouse. Let's say the higher earning spouse delays until age 70 and the lower earning spouse is younger. The lower earning spouse can claim in a survivorship situation, can claim that full age 70 benefit at his or her full retirement age and will not get any benefit by waiting beyond full retirement age, beyond age 67 in this case. So maximizing survivor benefits. How does one do this? It will depend on the age at which the deceased spouse originally claimed his or her benefit. So we often like to talk about this with our clients, that to maximize the value of Social Security to your spouse, if you think there's a good chance. Remember, men and women have different life expectancies. Women tend to live 4 to 5 years longer. You can maximize the benefit to your spouse by potentially maximize by waiting to claim your own benefit until age 70. And again, this is going to be amplified by those cost of living adjustments. The age at which the widower claims a survivor benefit, that's going to determine the actual benefit. So the surviving widow or widower will maximize their own benefit by claiming at full retirement age or later. And the or later is in there because there might be a benefit, and this can be shown through some complex work in our retirement planning and also in our Social Security calculators, is actually switching from one benefit to another. And it just all gets into timing of benefit claiming and how much you're receiving, what the cost of living adjustments are. But the bottom line is you're not going to get an increase to your survivor benefit by waiting past full retirement age. So strategies for widows and widowers. When eligible for both a retirement benefit and a survivor benefit, start with one benefit and switch to the other. And this is simply a way of maximizing the dollars. So if for example, your survivor benefit is going to be higher than your own benefit, wait until your survivor benefit matures at your full retirement age, and before then claim your own. And that way you're going to be maximizing the benefit that you get out of Social Security. Always take the higher benefit last. This is an excellent rule of thumb for people who are eligible for multiple benefits at the same time. If the survivor benefit is higher, start the retirement benefit you're on your own work record at age 62, and then switch to the survivor benefit at your full retirement age. If the retirement benefit is higher, think about starting the survivor benefit at age 60 and then switching to a retirement benefit at age 70. So all interesting things to consider. And this is something we call sequencing. So here's an example of sequencing. Wanda, age 60, her primary insurance amount, this is the amount that she would get at her full retirement age, is $1,200. Her deceased husband's primary insurance amount is $2,600. So let's take a look at a couple scenarios here. Scenario one, Wanda is going to start her own retirement benefit at 62. And that's going to produce a benefit of that $1,200 multiplied by 70%, which is accounting for the 30% reduction that she faces by claiming early. And that's going to give her a benefit of $840 per month. And then she's going to switch to that survivor benefit at her full retirement age, and that will be $2,600 at that time. In scenario two, Wanda starts her survivor benefit at age 60, and that's going to be $2,600 times a reduction of a little less than 30%. We're going to be multiplying that by 0.715, and that's going to produce a benefit of $1,859. So how do we know the way to determine which one of these strategies is going to produce the greatest benefit to Wanda will be to look at these scenarios under the microscope and project out lifetime benefits, taking into account a reasonable expectation for cost of living adjustments. So here we go. The type on the screen, I apologize, is very small. I would like to say that anybody attending this webinar today will get these slides, and each slide will be a full page on a PDF. And so if this is too small for you and you're unable to zoom in on your screen, I do apologize, but you will be able to take a closer look once you get those slides in your email. So these scenarios here, strategy 1 right here, Wanda claims early the lifetime nominal benefit. So this is the benefit that includes the cost of living adjustments of 2%. And you can see the assumption here up at the top of the screen, COLA, the nominal benefit, we're going to be using 2% in this example. The lifetime nominal benefit is a little over $1.1 million if Wanda lives to age 95. Now, scenario number 2, which is where Wanda claimed on her own record at age 62 and switched to the survivor benefit at age 66. This is going to produce a nominal benefit of a little over $1.4 million. So it's an increase of a little under $300,000, but that $300,000 is spread out over a long period of time. And this is why life expectancy is such an important aspect of retirement planning. And at some point, this break even might happen so late that it actually makes more sense, especially since there can be a bit of a push-pull. Retirement expenses as far as lifestyle tend to decrease with age. Medical expenses tend to increase with age. And our clients are really in the driver's seat. It's what will fundamentally make them sleep best at night. Having more money now or more money later. Ultimately, we can help guide that conversation, but it fundamentally has to be about what you're most comfortable with. So a basic rule number 4, if you claim benefits before full retirement age and work, your benefits will be withheld, and this is called the earnings test. If you go all the way back to our second webinar, I had one of those brain freeze moments where all the keys in the typewriter are jumbled up, and I was forgetting the term earnings test. But this is simply a system that's used by the Social Security Administration to reduce your benefit while you're working up until your full retirement age. And then at your full retirement age, your benefit will be restored. So that money that they withheld will be returned to you. So it's not a permanent reduction. So we're going to take a little bit of a closer look here. If you apply for Social Security before your full retirement age and you work, $1 in benefits will be withheld for every $2 you earn over the indexed amount of $18,960. And that's this year. That does increase every single year. The benefit will be adjusted at full retirement age. And in fact, for the year preceding your full retirement age, the formula changes a bit, and $1 in benefits will be withheld for every $3 you earn. And the point here is that because of the benefit adjustment that happens at your full retirement age, you should not let the annual earnings test discourage you from working. However, it can result in your benefits being completely eliminated, in which case it might make more sense to just wait until full retirement age and not deal with any of this complexity. So the little known rules about the earnings test, it applies to all benefits received before full retirement age. So that includes retirement, spousal, and survivor benefits. So it may cause your spouse's benefits to be withheld entirely. So if your spouse is claiming Social Security on your record, claiming a spousal benefit, and you keep working, their benefit will be reduced potentially all the way to 0. So John and Jane are 62, John files and Jane files for her spousal benefit. If John goes back to work, Jane's spousal benefit will actually be completely withheld. So if you are self-employed, you may be subject to extra scrutiny here. And that refers to the audit risk when you are doing your taxes. Because there are, of course, if you're self-employed, little games that you can play within the tax code to reduce or increase the amount of income that you're taking from the entity, the tax entity that you're using for your corporation. This is especially true for C Corps. We're not going to go too much into the weeds there, but just know that if you are filing for Social Security, you could be increasing your audit risk if you are self-employed and still working. So basic rule number 5, your benefits may be subject to tax. In fact, for the overwhelming majority of people, they will be subject to tax. And this all depends on how much other income you have. And I mentioned in the front end of our webinar today about how back in 1983, there was a Social Security solvency crisis, and the government solved it. And one of the ways they solved it was by taxing Social Security. And there are a lot of people, members of my family included, who are on one side of the political aisle or another, and they despise taxes and look at all forms of tax increase as a giant power grab by the government. But in this case, what that Social Security taxation did was help preserve this system so that it's there for all the people who are claiming it right now, and that they have their full unreduced benefits if they wait until full retirement age. So these changes, they do hurt a bit, but it's a little bit of pain for a whole lot of good that they do for the entire country. So let's take a look at this. The taxation of Social Security benefits. These numbers, when they were imposed in the 80s, did not have any indexing associated with them. So these numbers that you're looking at are the same numbers that existed all the way back in 1983, which is ridiculous. And I think that was actually done just to ensure the maximum amount of tax dollars can flow back into the system. So if you're married filing jointly, this is called provisional income. Provisional income is 1/2 of your Social Security benefit plus your modified adjusted gross income. There's actually a bit of a mistake on this slide. It's not your adjusted gross income, it's your modified adjusted gross income. And that, actually is accounted for here where it says tax exempt interest. All your modified adjusted gross income means in this example is it's your adjusted gross income plus tax exempt interest received from municipal bonds. So municipal bonds have a great tax benefit. We use them at SeaCure Advisors all the time when we're constructing bond ladders, for example, in a taxable account. I'm not going to talk about bond ladders right now. Just know that there's not going to be a benefit in terms of saving you taxes on Social Security when it comes to using municipal bonds. So if your provisional income for married filing jointly is under $32,000 for the entire year, then you will not have to pay taxes on Social Security. And that's, we're not going to get into Roth IRAs right now and other ways that you can have tax-free income in retirement, but this is one of the great benefits of Roth IRAs in retirement planning is it allows you to have income. They allow you to have income that will not appear on the books. So the more tax-free income you have, the less taxes you may have to pay on Social Security. So once you get in this window, $32,000 to $44,000 of provisional income, you're going to have to pay taxes on half of your Social Security benefit. That is not to say that half of your Social Security benefit will be taxed at that rate, meaning a 50% tax rate. It just means that 50% of your benefit will be exposed to taxes through the ordinary income tax system where you have your tax brackets. So over $44,000, you will be exposing your Social Security benefit. 85% of your benefit will be exposed to taxation. Again, it doesn't mean that the tax rate on your benefit will be 85%. It just means that our tax system with those marginal rates will be applied to 85% of your benefit. And this speaks again to how great Social Security is in retirement planning, how important it is in retirement planning, because even at the very worst, currently, there will be 15% of your Social Security benefit coming to you tax-free, which is fantastic. Now, if you're single, these numbers go lower. And if you're married filing separately and living with your spouse, these benefits go all the way. There is no provisional income formula. 100% of your Social Security benefits will be, I should say 85% of your Social Security benefits will be exposed to taxation. And someone might say, well, why on earth should I do married filing separately? It is a curious thing in our tax code. Married filing separately is treated punitively, seemingly. You are unable to contribute to a Roth IRA, for example, if you're married filing separately and earning more than just $10,000 worth of income annually. Why would someone do married filing separately? Where there are situations where it makes sense. And one of those is dealing with student loans. There's income-based loan repayment plans for student loans. Student loans are a huge issue in the country right now, and a way to reduce the amount of payment you're required to make over time until that loan has the potential to be forgiven. With medical school students, you're talking about 6 figures and up of student loans required to complete that education. These married filing separately strategies can actually be really valuable, even in light of some of these punitive measures in the tax code. It's all about this push-pull. What is getting the greater benefit, the reduction of the student loan payment, or the ability to participate in more of these tax advantage retirement options that are allowed in the tax code. Ways to minimize taxes on Social Security benefits. Number one thing, reduce other income with tax advantage investments, not municipal bonds. So tax advantage and investments, there are not too many of those, but there are ways that, that you can use, for example, brokerage accounts, which are exposed to capital gains taxes, which can be more favorable to some people than IRAs. If we have a client, I have a client where if you actually look at their average tax rate that they're paying on income, it's actually lower than the tax rate that they're paying on for capital gains. So that would be an example of that not working. And it just speaks again to how retirement planning is really necessary to be done on a case-by-case basis. There are no one-size-fits-all solutions here. Anticipate your IRA RMDs, which may put you in a higher tax bracket, and consider drawing down IRAs before age 72. So one way you can draw down IRAs is by paying debts, paying off debts. You can also just use your IRAs for retirement income and to supplement what would be a Social Security benefit by using your IRA, and then using that IRA income to delay claiming Social Security until age 70. Another tactic that we're seeing a lot right now, because we know that tax rates are going to increase in 2026 when the current tax law sunsets. The Tax Cuts and Jobs Act is scheduled to end at the end of 2025, at which point our tax system is going to revert, our tax brackets are going to revert back to what they were before the Tax Cuts and Jobs Act, which means that your taxes may go up, even for middle income families in America. So one way you can hedge against this is by converting a portion of your IRAs to Roth IRAs. This is very complex. There's a whole hour-long workshop that I do on Roth conversions, and it deserves even more time than that. And again, it needs to be evaluated on a case-by-case basis. It's not something that should just be entered into, assuming that you're going to come out ahead just by doing a Roth conversion. And all of this speaks to delaying Social Security. So this is going to reduce the number of years that your benefits are going to be subject to tax. And again, this can be projected out to show how much benefit you're getting lifetime over a delayed strategy. Reducing your expenses. So the amount of income that you need to pull from your retirement accounts will have a huge impact on the amount of taxes that you're paying. And that amount of income is going to be dependent on your required minimum distributions from 401ks and IRAs, and also your expenses. So for example, I'm working with a family right now that has very low expenses. They do an excellent job managing their lifestyle. And as a result, they've done an amazing job saving, and they're now in retirement. And we're calculating out, looking at their RMDs that are going to start in a couple of years, and they actually have more money in RMDs than they need for annual income. So this is a bit of a problem. This means that their taxes are going to be higher than they need to be. And this is a case where Roth conversions might make sense for that particular family. But it's, again, a case-by-case basis. And then obviously the tax code changes. It changed twice while I was studying for my CFP exam. That was interesting. It actually changed a third time right before the exam with the CARES Act. Unfortunately, I didn't have to answer questions on that in my exam because it had happened so recent to my test sitting. But just know the tax code is written in pencil. The Social Security laws might change. For example, there's the SeaCure Act that came out in 2020. It was signed into law 2019, came out in 2020 January. And we're now looking at the Secure Act 2.0. There's a new Secure Act that you can read about that is working its way through Congress. A couple of the things, a couple of the provisions that are in the Secure Act is actually gradually moving the RMD age all the way out to age 75. Another couple points that are in there that are very interesting is creating Roth SEP IRAs and Roth simple IRAs for people who use those instruments in their retirement savings strategy. So the tax code is written in pencil, changes all the time. And so this is a situation that needs to be managed on an ongoing basis, not only while you're saving money, but especially as you're distributing money out of those accounts that you've saved into and turning those accounts into retirement income streams and legacy benefits for your heirs. So all these things need to be managed on an annual basis. So you have questions, we can help. This is a complex situation. It varies on a family to family basis. Answering these questions: when should I apply for Social Security? What if I want to keep working? What if I've already applied? How much will my benefit be? On and on and on, especially that last one. What do I do next? Well, what you should do next is talk to a planner. Our first, to meet with us, the first meeting is always complimentary, and what you get from that meeting is a report. And I have mine right here. Here they are, buried under my my reading material for today. But I have a couple examples here. We can run several different types of reports. We have a spousal analysis report. We have a break-even report. If you're a high earner and you don't need Social Security, and you're going to get this benefit, we can actually show you what it would look like if you invested your Social Security income rather than using it to pay expenses. So there's a lot of different options that you have with your Social Security check, and we have the ability to show a lot of these options, what the long-term ramifications will be in your overall financial plan, as do other financial planners. I do recommend that you work with a CFP no matter who it is you work with. We are held to a standard of care in terms of how we work with clients, and have a certain educational requirement that we've met to get our CFP designation and must maintain through continuing education. It does not take much in the way of education to be able to render financial advice and charge a fee for it. One of the ways you can hedge against that, the risk of getting bad advice from someone who's less experienced, is by dealing with a certified financial planner. So please do make use of that. You can actually go online to I Need a Plan, I believe is the website, and you can find a certified financial planner in your area if you're not local to Lexington and you want to work with someone local. We are in Lexington and Sarasota, Florida. So do please ask for help. Google is great. You can do a lot of great research if you're a DIY person like me. But when it comes to these kinds of things, it really does make a huge difference being able to talk to a professional who works in this space all the time. I can't speak for everyone in our firm. For me personally, the greatest joy I get is knowing that as far as the work that I do, the greatest joy I get is knowing that I'm helping people enhance their prosperity, enhance their happiness with money. Money can be a ball of stress for a lot of people, myself included. And I hate that. I want to be able to turn it into a source of happiness for people. And by educating myself, I do love to learn, and by learning all the time, studying this stuff every single day, I'm able to pass that on to people and help enhance their prosperity and help them thrive throughout retirement. So please do schedule an appointment with us using this link at the bottom of the screen if you need help. So let's see here. Last slide. Social Security is too important for guesswork. It really, really, really is. This is a decision that you can be stuck with for the rest of your life. It is amazing the number of people I've encountered who have started claiming Social Security at age 62, just for whatever reason. I don't know why. It just happens a whole lot. A number of people I talk to just casually, when I tell them what I do, and we'll start having conversations about money. And one of the things that will come up is Social Security, and then, oh yeah, I'll just take it at 62. Like, what? Why? Like, it's just this default setting. Claim it early. You must have intent behind everything that you do. One of the greatest ways to ensure that you have a retirement plan that works, that will enhance your life for the rest of your life, is to have a purpose and an intention and mindfulness behind every single financial decision, including when you claim Social Security. So I'm done talking. I've talked a whole lot. Here's our information, our link to schedule a meeting, our email addresses and phone numbers. I'm going to turn off the screen share now, and we can take some questions if there
Okay,
are.
we do have some questions.
Wonderful.
So one is, let's say I started taking my benefits at age 70, and I switched to a spousal benefit once my husband took their retirement benefits. If the spouse benefit is larger than my own, should I switch to his benefit?
Yes.
So basically, basically, I don't think you would switch. What you would do is just add on the spousal portion to the benefit.
Correct. Yeah, I mean, you would have, in order to add the spousal portion, you would need to you would need to file for it, and that's actually it brings up a good point. When you file, if you have earnings on your own record, and a lot of women, we covered this in our webinar for women, a lot of women have reduced earnings, have suppressed earnings because, and a lot of 0 years on their earnings record because they take breaks from careers to care for children, to care for aging parents. This is a burden that falls on women more than it does men, just statistically. Not making a statement about it one way or the other, it's just a statistical reality. So it is entirely possible that your spousal benefit will be greater than, which is your spousal benefit being 50% of your spouse's benefit. Your spousal benefit could be higher than your full benefit, in which case you could claim on your own record and then apply for your spousal benefit. And if there is a difference, so if your own benefit is smaller, including delayed credits, than your spousal benefit, the spousal portion, that's that difference, that increase between your spousal benefit and your own benefit, that simply gets added on top. So technically at that point, if you want to really get into the nuts and bolts, technically you're receiving two benefits at that time, your own benefit plus the spousal. But of course, the only way to do that would be to file for the spousal benefit. So this stuff is really, really difficult to just talk about. You know, I think the easiest thing in a lot of cases is to actually see a report, see the numbers, and make a decision based on that. Because trying to understand it conceptually, it's hard. I need something for myself. I need something directly in front of me that I can actually look at. Because trying to wrap my head around this stuff on a conceptual basis, I get that typewriter effect where just all like my brain breaks and little.
There is one other question.
Yes.
So the other question is, and I think this is more of a clarification. So if my spouse is the highest income earner and she waits until 70 to take the income, do I get half of the 70-year-old income or half of her primary insurance amount?
That is a super important question. We actually did cover that today.
I just wanted clarity.
Not scolding the viewer, just saying, it's entirely on me. I need to do a better job explaining, but, and we also did cover this in the previous webinars as well, but there is no benefit to delaying a spousal benefit filing. So if you're filing for spousal benefits, the most amount of money that you will receive is at full retirement age. And that will equal your spouse, what your spouse was going to receive. Your spousal benefit will never be more than 50% of the higher earning spouse's primary insurance amount. There are no delayed credits for the spousal benefit. I hope that's clear.
Yeah, so the only time a spouse would actually get delayed credits is if the higher income earner had waited till 70 and passed away. And then
Correct.
Whatever that
or when filing for their own benefit.
Yeah, or when filing for their own benefit. Okay.
And even then, like the delayed credits by waiting till if the higher earning spouse waits until age 70 to file, they get all those delayed credits and then passes away. Those delayed credits pass to the surviving spouse in full by the surviving spouse's full retirement age. So there's no benefit for the surviving spouse to wait until age 70 to claim a survivor's benefit, because the survivor benefit doesn't increase beyond the surviving spouse's full retirement age.
Yeah. Okay. Those are all the questions.
Oh, very cool.
Yeah.
One thing I did want to add that hasn't been covered in these webinars, because it's going away, is a strategy called file and suspend. And again, this is a question that we got offline after our last webinar dealing with Social Security benefits for women. So file and suspend was eliminated with the Bipartisan Budget Act of 2015. Again, this is little incremental changes to the Social Security system to ensure its solvency. File and suspend used to allow someone in a situation where there's a higher earning spouse and a lower earning spouse. Let's say I'm the higher earning spouse, my wife is a lower earning spouse. I can file for my own benefit and then suspend. So file and suspend immediately. When I do that, my wife can claim my spousal benefit. And so that will allow her to earn money on my work record, even though technically I'm not receiving any Social Security. It can also mean that I can earn Social Security benefits off of my spouse. The bottom line is file and suspend allowed people to delay filing for their own benefit while collecting benefits off of their spouse's record. And it was a loophole in the system. I don't think the system was ever constructed to do that. And that loophole was closed in 2015. However, that the file and suspend strategy is still available as long as you were born before 1954. So if you're born before 1954, you can still use file and suspend. Anyone born after 1954, file and suspend is not available to you. However, restricted filing is still available for you. Restricted filing is simply where you have multiple benefits available to you, like your own benefit and a spousal benefit, and you file for one but not the other, and that's the difference. File and suspend is a loophole strategy that expired in 2015, although it is still available to some people. Restricted filing simply allows people to file for one benefit that they're eligible for but not another. So we talked about that a little bit today. We talked about that in regards to a sequencing strategy where someone is eligible for a survivor benefit, but wants to wait until their full retirement age to claim that survivor benefit. And in the meantime, does a restricted filing for their own benefit. So they're filing for their own benefit, but restricting their Social Security benefit to just their own benefit, even though they're eligible for both. And then they're going to wait until full retirement age to claim that survivor benefit at age 67, let's say. So that's an example of restricted filing, and is absolutely something that is available to people. And in cases where there's a higher earning spouse and a lower earning spouse, there can be some benefit depending on how the numbers shake out. There can be some benefit to doing restricted filing, where a spouse can file for a spousal benefit and then their own benefit at a later time, but restrict that application to the spousal benefit first. So this gets really into the weeds again. Just know there is a difference between a restricted application or restricted filing and file and suspend. These are two separate things, and it all depends on when you were born. 1954 or earlier, you still can use file and suspend, but we're coming right up on the year at which everyone born in 1954 will be age 70 or older, in which case file and suspend will be dead and gone forever. So at which point we're only looking at restricted filing situations. So
Yeah,
that is
that
it.
actually ends in 2023.
2023, there you go.
Yeah.
So, right. And so at this point, there would actually probably be, with only a couple years left, basically a year and a half left, right? Before file and suspend is gone, there would be limited utility to it at this point if you're just now considering it. But something's better than nothing. So if this is a situation that applies to you and you haven't yet filed for Social Security benefits, definitely do schedule an appointment with us or another CFP in your area. And that is it. So I've got nothing left. How about you, Carolyn?
No, all the questions have been answered.
All right. Well, wonderful. Thank you so much, everyone, for sticking with us. You should be getting an email as soon as this is over with a questionnaire, so you can let us know how we did. And you'll also be getting an email from me with the slides for today's presentation. And also, all of these presentations that we've conducted will be available on demand. They have all been recorded, and that is it. So thank you so much. It really means the world to us that we're able to deliver this information to you, and hopefully give you an idea of the options that are out there and the potential that you have for success in your own retirement plan. So happy planning, everyone, and wish you much happiness and health. Take care.